why I was wrong. And I'm actually really excited to have discovered what I did. And it all goes back to a little side bet that I had with my good buddy, Brent Johnson. Now, I think I'm going to be right about interest rates over the long run. But Brent put out a tweet the other day where he said that he was buying puts on the TLT, meaning he was betting that the price of the TLT would go down. In other words, long-term interest rates would go up. And his expiration, I think, was like October 17th, something like that. So I came out and said, Brent, I will buy you the first round in Medellin because he's coming down to Medellin in January. I've got something called the Rebel Capitalist Retreat down here. I said, the first round is on me. I'll take the other side of that, meaning that interest rates will be lower at the long end, or TLT, when we get to October 17th. Now, we're not there yet, but so far, like I said at the beginning, I have been completely and totally wrong. But what's really interesting is why I was wrong. And this is where I think you guys are going to really get some, not just value, but I think you guys are really going to find this fascinating. So let's get into it here. I actually did the whiteboard on this morning, and it was just such a cool topic. Let's start by going back to 2007. Because this is the last time the Fed dropped by 50 basis points, at least started the rate cutting cycle by a 50 basis point drop. Now, if you guys, excuse me, if you guys recall, just what, 3 or 4 weeks ago, on September 18th, 2024, the Fed dropped rates from 5.25 down to 4.75. I mean, we all know this. But what most people don't know is that if we go back to 2007, in fact, let's go back to, I don't know, let's go back to September 18th, 2007. What do you think happened then? Would you look at that? The Fed dropped by 50 basis points. And that brought the Fed funds rate from 5.25% down to 4.75. I'm not making this up. And if you thought we were in or living in a simulation prior to this video, now you can show this to all your friends as to proof that we are definitely living in the Matrix. We're definitely living in a simulation, and whoever is in charge of this simulation has a sense of irony and at times a sense of humor. Exact same day, exact same 50 basis point cut, bringing the target rate to the exact same 4.75. And this is just the tip of the iceberg. So if I don't already have your attention, now it is definitely stiff drink time. You're watching this video, I don't know what you're doing, but have a seat and buckle up, because this is when we go from interesting to completely insane. You guys know from watching my videos that I always say this time is likely not different. These cycles always seem to play out the same. It's where we get the Fed increasing rates, and they pause, then they start to drop rates. We have an inversion of the yield curve. Then we start to have a bull steepener, where the front end comes down faster than the long end. In other words, short-term interest rates come down faster than long-term interest rates. Okay. And then you usually see the unemployment rate start to go up. And then you usually see the curve uninvert. And then the Fed drops rates. And then the stuff usually hits the fan. And then 9 months, a year later, the NBER comes out and says, oh, yeah, by the way, we've been in a recession for the last year. Even though we were telling you the economy is resilient and strong, just my bad, rug pull. This is the cycle. And so this is, and I was looking at it from a 30,000 foot level, and I wasn't getting into the nuance. I wasn't doing my homework. And this is the big mistake I made. And this is one of the reasons why I was so catastrophically wrong and will likely lose that bet to my good friend, Brent Johnson. So instead of just kind of looking at this from a 30,000 foot level and say, okay, yeah, this happens, then that happens, then that happens, and that happens. Therefore, when we look at the Fed funds, look at this. When they start cutting, they don't just cut a little bit. They usually cut a lot. I say it's not gradual. I think the term I've been using on my whiteboard videos is it's like a water slide at Wet and Wild. Just like that. They always say it's going to be gradual, and it never is. And therefore, I thought the probability, especially when rates went up slightly, when they dropped 50, and then they kind of started to roll over every single time. And we've done tons of videos on this. So I thought the probability of rates at the long end going up and up and up and up was very, very low due to me zooming out and looking at this from a 30,000 foot level and not zooming in and actually doing the homework. So once I did the homework, I saw why I was completely wrong. So let's get into it. First, let's look at the rate of inflation, because I just looked this up this morning and I was completely floored. I had no idea the CPI did what it did between 2007 and 2008. I always knew that we had a bit of deflation, actual deflation in 2009. But I never really looked into what happened from September 18th, 2007 to, let's say, the middle of 2008, just prior to basically the whole global economy imploding. So let's start by looking at a chart, and we're going to focus. I'd like to focus on this red line, but we need to zoom in. So we're going to try to get really specific and look at this time frame of the Fed rate cutting cycle that started in September of 2007. So right here, you can see, and I don't know if you guys, it's fine print, but as of the 30th of September, 2007, the headline CPI, according to longtermtrends.net, was 3.54%. And then the Fed dropped by 50, but they weren't done. Let me show you. Let's go over to bank rate and look at exactly what they did. And I want to focus, first of all, from the start to April. So we've got a 50 basis point cut. We all know that. But then in October, 25, December, 25, January, emergency meeting where they dropped 75 basis points a week prior to meeting again and dropping another 50. March, they drop another 75 basis points. April, they drop another 25, taking the Fed funds rate all the way down to 2%, from 5.25 down to 2%. That's a decrease of 325 basis points within a matter of, a few months. But look at what CPI did. The CPI went from 3.54 up to, in April, almost 4%. And then in June and July, it got up over 5%, to where in August, the CPI report came out. I believe it was on the 18th, maybe the 17th. And this was the CPI report for the month of July. The CPI had gotten up to 5.6%. 5.6% from 3.5. So think about the narrative back then. The Fed is cutting from 5.25 all the way down to 2. And during this time, inflation is starting to accelerate higher and higher and higher. So now what I want to do, just so we can try to put ourselves in that time, because, hindsight's 2020. We can all sit here and say, oh, well, if I was, if you transported me back to 2007, if I was paying attention to markets back then, I definitely would have known we were headed for the GFC. And obviously, everyone on CNBC, everyone on Bloomberg, if Twitter was a thing, everyone on Twitter, all these experts, well, they would have been saying that, hey, we're headed straight for a recession or a hard landing. Nobody would have been talking about a soft landing or a no landing back in 2008. I mean, no chance. But when we actually examine what really happened, we see that they were not only talking about a no landing or a soft landing, they were talking about inflation accelerating to a point where in August of 2008, the debate wasn't whether or not the Fed would drop rates again. It was whether or not the Fed should increase rates to combat a potential problem with inflation. August of 2008. If you don't believe me, check this out. And again, just try to put yourself in the position of kind of living through this and not knowing what was going to happen. I mean, when you see the Fed dropping that much and inflation going like this, what do you think everyone would be saying? Everyone would be worried about inflation. Can you imagine the gold bugs and the Bitcoiners if they were back then? Oh my, hyperinflation, think about what Zero Hedge would have been saying back then. The Fed is way offsides. They should have kept rates at 5.25%. They cut into a resilient, strong economy, but the jobs numbers are low. They're crazy. They're going to ignite the next wave of the 1970s. The dollar is going to crash. This is exactly what you would have heard. Check this out. And not just on Zero Hedge. This is straight from the Wall Street Journal. The day after, this is in August, the day after the CPI came out for July, that showed that we had got up to 5.6%. I'm going to read straight from the article. The Consumer Price Index rose 0.8%. That's month over month, reflecting increased prices for food, energy, airline fares, and apparel. The Labor Department said Thursday that followed, okay, they go over month over month stuff. Harm Bandholz, economist at UniCredit, said a truly ugly inflation report. Going down to the bottom here, that suggests Federal Reserve policymakers are unlikely to raise rates. Well, they start, but wait till to hear how they conclude. Despite their policy statement the week prior that inflation remains a significant concern. The Fed is generally expected to keep the official interest rate steady into the next year, though rate increases could end up back on the table later this year if inflation persists. So I would like to remind you that here were worried about inflation and discussing whether or not the Fed should be increasing rates. This is the mainstream narrative. Just 2 or 3 months later, interest rates were at 0%. And less than a year later, the CPI was at -2. But we're not done. We're not done. Let's look at the mainstream narrative going back to September 18th when they first started that rate cutting cycle, because everyone that you listen to in the experts and the talking heads and whatnot would say that, oh, well, this time is way different than 2007. I mean, everybody knows that. Everybody knows that it was much, much different back then for X, Y, and Z reason. As if the narrative back in 2007 was that the economy was headed straight for a recession, so the Fed better cut rates ASAP. Let's check this out. Let's go back to the Wall Street Journal. I absolutely love these archives. This is worth the subscription cost. Here we go. So they're talking about the Fed dropping 50 basis points. They said the steep reduction in the Fed funds rate surprised many on Wall Street who expected a more modest rate cut, 25 basis points. Does that sound familiar? So if Wall Street or CNBC or whatever, if they were hey, everyone back then knew we were headed straight for a hard landing. Duh. Really? Then why were many on Wall Street surprised, caught off guard that the Fed dropped by 50 basis points? And oh, by the way, I forgot to mention that October 9th of 2007, stocks hit an all-time high for the cycle. From there, they went straight down. And if you look at the Dow today, you see, in fact, let's do it. We'll just go to CNBC real quick. And look at that. Today, if I am not mistaken, is not October 9th, but it is October 8th. And the Dow Jones is at or very, very close to an all-time high. If the Dow Jones hits an all-time high tomorrow, October 9th, then we can say definitively we are living in a simulation. But let's get back. You just can't make this stuff up. But let's get back to the Wall Street Journal here. The rate cuts should reduce payments on many home equity lines of credit, credit cards, and some car loans. So you see what they're doing. It's the exact same thing they do today. Oh, nothing to see here. No worries. That the Fed's, it's a Fed put, right? The Fed's got our back. The Fed realizes that some people are having a little hard time paying their home equity line of credit. So these rate drops are going to get ahead of the problem. And we know the economy is strong and resilient. So as soon as they drop by 50 basis points, problem solved. Are you fear-mongering? Okay, tinfoil hatter. Getting back to the Wall Street Journal. Perversely, however, some economists say it could lead to higher rates if the bond market expects the Fed move will spur higher economic growth or inflation. The exact same narrative that we hear today. And to be very, very clear, from September to June of 2008, they were right. They were right. If my memory serves me right, we did see GDP go up, and we definitely saw inflation accelerate. But now let's go back to bank rate and point out this emergency meeting. Because you would think that after the Fed dropped by 1%, 100 basis points, and then within a week's time, they dropped by 125 basis points, and 75 of those and 75 basis points of the cuts came at an emergency meeting. You would assume that by now, okay, George, okay, everybody at this point in time would have known that we were headed straight for a hard landing. I mean, the experts, the talking heads, the mainstream media, it would have been completely unanimous. Let's go back to the Wall Street Journal. This is the opinion of a guy named Bob Eisenbies. And he just happened to be the former executive vice president of the Atlanta Fed. The Atlanta Fed that's so good at predicting GDP. Here we go. And this came out right after the emergency meeting and the 75 basis point cut in January. The central bank's move drew criticism. As an example, Bob Eisenbies, a former executive vice president, Atlanta Fed, criticized Tuesday's rate cut, characterizing it as premature in light of the Fed's policy meeting slated January 29th, just 1 week from when this was written. Today's move raises questions about whether the Fed has caved to market pressures, wrote Mr. Eisenbies. It is hard to conclude anything other than this move was geared to address market psychology rather than emerging weakness in the real sector. In other words, the Fed is just doing this to throw a bone to the stock market, and this has nothing to do with underlying economic weakness in the real economy, because everybody knows that the real economy is strong and resilient. History doesn't repeat, but boy, oh boy, does it rhyme when you really get into it. So now let's look at the 10-year Treasury, and we'll just use this as a proxy for the TLT, going back to that bet that I had with my good buddy, Brent Johnson. So here are, way too far. Interest rates on the 10-year Treasury. And let's zoom in again. All right, cool. Right here, January 22nd, that's when they had the emergency rate cut of 75 basis points that brought the 10-year Treasury yield down to 3.52%. But look at this. And keep in mind, from this point to April, the Fed cuts another 150 basis points to 2%. So you would think that the 10-year Treasury would have to drop as far as yields. But look at what happened. Did the exact opposite. The 10-year Treasury yield went from, call it 3.5%, all the way to 4.27. Again, I know I'm beating a dead horse here, but this happened while the Fed was dropping interest rates 150 basis points. The 10-year Treasury yield was going up. Why? Because the market thought that those Fed rate cuts were leading to and going to lead to an acceleration of inflation. Not just from September to, call it June, but through 2008 into 2009, potentially even into 2010. Then 6 months later, the 10-year treasury yield is trading at, let's call it 2%. And the whole entire world, including all the people that were saying the economy is strong and resilient, are freaking out, saying that the United States and the global economy is going into the greatest deflationary depression since the 1930s. So I am extremely happy that I actually lost this bet, or I'll likely lose this bet to my good buddy Brent Johnson, because if I wouldn't have lost, I never would have gone back and done the homework required to actually figure out what really happened, not just throughout the cycle, but what was happening in between every single point from A to Z. Because if we want to set up our portfolios to actually make money, then we have to be cognizant and aware of history to a point where we're just not looking at the cycle, but we're actually digging into the nuance and seeing what happened from month to month to month, not just with the Fed funds rate, but with the long end of the curve, with the CPI, and probably most importantly, what was happening with the narrative. All right, guys, on that bombshell, I want to encourage all of you to stand up for freedom, liberty, free market capitalism, and I will see you on the next video.